The most dangerous thing you can do right now is look at the price of Bitcoin in a vacuum. If you are just staring at the red candles, you are missing the massive signal flashing behind the scenes. Look at this. While price has been chopping and bleeding down towards $87,000, the number of entities holding at least 1,000 Bitcoin, the real whales, has gone vertical. We have not seen a divergence this aggressive between price action and whale accumulation since the bottom of the bear market. Price is going down, whale count is going up. Retail is getting bored and selling, while the smart money is stepping in to scoop up that liquidity. This is a classic transfer of wealth, and if you are not paying attention to who is on the other side of your trade, you are about to get left behind. We are sitting at a pivotal moment where sentiment says bearish, but the on-chain data is screaming opportunity. Right now, Bitcoin is trading around $87,000. It feels heavy. I know the sentiment out there is terrible. You check X, you check the news, and everyone is talking about how gold and silver are the new kings, while Bitcoin is the disappointment of the cycle. We have been chopping in this range for weeks, and the boredom is starting to convert into fear. This is exactly why we need to have this conversation today. The market is testing your patience. We have lost the short-term moving averages, and the momentum has clearly slowed down since December began. But before you panic sell your spot bags or open a high-leverage short, you need to understand the context. We are seeing a rotation, not a death spiral. I want to bridge this gap for you because while the price action looks weak on the daily time frame, the fundamental engine driving this market has not stopped. In fact, it is revving up. But there is a specific technical structure on the weekly chart that I'm watching like a hawk, and it completely changes how I'm viewing this dip. Let's look at the narrative driving this fear. Recently, silver actually flipped Bitcoin in market cap to become the world's third largest asset. You see the headlines, right? Silver is the new Bitcoin. But let's look at the data properly. Since the cycle low, Bitcoin is up 465%. Gold is up 178%. Silver is up 307%. When everyone is worried that something is ending, usually you are closer to a beginning. This rotation is normal. The Bitcoin therapist put it perfectly. Gold rallies first, then Bitcoin rallies harder. It is a flow of capital from safety to risk. And speaking of risk, look at the Russell 2000. It is heading for its highest monthly close ever. Why does this matter? Historically, every time the Russell 2000 breaks out like this, it signals a massive risk-on environment where Bitcoin goes vertical. The traditional markets are signaling that the liquidity taps are opening, and Bitcoin is lagging behind. That lag is your opportunity. We also have the rational root on-chain value map showing us that even at $89,000, Bitcoin is strictly in the fair value band. We are not overvalued. We are not in a bubble. We are fairly priced. And remember that whale chart I showed you in the beginning? That is Bitwise and Glassnode data. The price is dropping, but the wallet count with over 1,000 Bitcoin is spiking. They are absorbing the sell pressure from impatient retail traders who are chasing the pump in silver. Do not be the liquidity for a whale. Now, let's get into the charts, because this is where we separate the noise from the tradable data. I'm looking at the weekly time frame here because that is what matters for a position trader. We are currently respecting a massive ascending channel that has been in play since the end of 2024. This is a year-long structure. In my opinion, this is a bullish continuation pattern. We are currently fighting with the lower support of this channel, right around that $84,000 to $89,000 area. Let's talk moving averages. We are trading above the 100 EMA, that is the yellow line, and the 200 SMA, the green line. That tells us the macro trend is still bullish. However, and this is important, we have lost the 10, 21, and 55 EMAs on the weekly. This indicates we are in a medium-term correction. We are cooling off. But here is what has my attention. Look at the Fibonacci RSI indicator below the price action. It is in extreme oversold territory. It has not been this low in a long time. I have drawn white circles on the chart to show you this. Historically, when this indicator hits these depths, price tends to bottom out and reverse. Sometimes there is a lag of a few weeks, but the probability is heavily skewed to the upside. We also have the MACD hitting the lower Bollinger Band, something we have not seen since the bottom of the bear market. Plus, on the 3-day chart, we are potentially setting up for a bullish cross. These are not signals you see at a market top. These are signals you see at a local bottom before a continuation. Now, let's talk Fibonacci levels. Anchoring from the $107,000 high in December down to the $77,000 low in March, we are currently testing the 236 support level at $84,000. The resistance to beat is the 618 level at $95,540. If we reclaim that, the game changes. My strategy here is simple. I'm a position trader. I buy low on high timeframes and I sell high. My load zone, that is the green box on the chart, is between $80,000 and $90,000. As long as we hold this channel support, I'm accumulating. If we break down from this ascending channel, my second accumulation zone is lower, between $60,000 and $70,000. But right now, the primary structure is holding. However, I need to mention the risk. Crypto Tony pointed out the USDT dominance chart. If USDT dominance reclaims the 6.41% level, things are going to get ugly for Bitcoin and Ethereum in the short term. We are watching that level closely. If stablecoin dominance spikes, it means people are fleeing to cash. That is our invalidation warning. So, what's the play? My stop loss is set at $76,000. This is crucial. A weekly candle close below $76,000 invalidates the specific bullish setup for me. It does not mean Bitcoin is dead, but it means this channel is broken, and I would step out of my short-term levered positions to wait for that lower $60,000 region. For the upside, I have very specific take-profit targets. The first target is $107,000, reclaiming the highs. The second target is $125,000, which aligns with the 1618 Fibonacci extension. The third target is $155,000, and my moonbag target is $180,000. I manage risk with trailing stops. If we hit $107,000, I move my stop loss to my entry. If we hit $125,000, I move my stop loss to the first target. This guarantees that I do not turn a winning trade into a loser. Remember, my current allocated portfolio is 40% Ethereum, 30% Bitcoin, 10% Solana, and 20% in the altcoins we discuss on this channel. It is absolutely essential to understand that for our alts to pump, Bitcoin must remain strong. If Bitcoin bleeds, the alts will bleed harder. We need Bitcoin to find strength here to give confidence to the rest of the market. To summarize, the macro data suggests a risk-on environment is loading. The on-chain data shows whales are buying this dip aggressively, and the technicals are flashing oversold signals at major channel support. I'm betting on the probability of a bounce here, not the certainty of it. I discussed this thesis in even more detail, specifically regarding those higher targets, in my last video from December 21st. Make sure to check that out if you missed it. I will link it on the screen right now. Be patient, let the chart come to you, and do not let the boredom shake you out of a good position. If you want to stay updated on these levels day by day, join my free Telegram community. I post faster updates there than I can here on YouTube. The link is in the pinned comment. Never financial advice, stay safe, trade your own plan, and I will see you soon in the next one.